Hey all, welcome back. In this video, we are going to do 20 must-know consolidation questions. I have picked up these questions from ACCA Study Hub, and these questions cover a wide variety of topics like goodwill, NCI, retained earnings, unrealized profit, markup margin, and many more. Okay, so let's get started. You can solve these questions along with me, or you can just watch the video, anything which you find good. Okay, so let's get started. The first question is, Alpha Company purchased 70% of share capital of Beta Company on 1 January 20x5. Okay, so question number 1. Alpha is the parent company and it has purchased 70% of Beta Company, which is our subsidiary. The fair value of NCI is 1,09,000. At 31 December 20x8, the retained earnings of Alpha are 9,05,000 and that of Beta are 5,70,000. What amount should be included in consolidated statement of financial statements for NCI? Okay, so first let us write the formula. The formula for calculating NCI is fair value of NCI at acquisition, and then to this we add share of post acquisition profits of NCI. So see, NCI is that portion of subsidiary which we do not own. Okay, we have purchased 70% of Beta. It means the remaining 30% is our NCI. Okay, because we don't own that part, right? So see, first in our formula we have fair value of NCI at acquisition. We are given it directly. See, 1,09,000. So here we'll write 1,09,000. Now we have to find share of profit of share of post acquisition of profits of NCI. So this company was acquired. Just a second, let me change the color. This is our working note. We acquired this company on 1st January 20x5, and today we are standing at 31 December 20x8. It means 5, 6, 7, 8 after 4 years. So when we acquired this company, its retained earnings were 2,40,000. And today, see, we have to see Beta companies' retained earnings. We don't have to do anything with Alpha companies' retained earnings. Just ignore it because NCI has a share in subsidiary companies' profits. So we'll look at the retained earnings of subsidiary only, which is Beta. That is 5,70,000. Now, at 31 December, the retained earnings are 5,70,000. We have to see the movement. Okay, when we acquired it, the retained earning were 2,40,000, and for these 4 years we must have added profits in the retained earning, and then we have arrived at the figure of 5,70,000. So we will take the movement. Okay, that is, we will write 5,70,000 minus 2,40,000, and we'll multiply it by 30% because that is the share of NCI. A owns 70% of B, so remaining would be 30%. So I'll multiply here it by 30%. So let's calculate it. So when you will calculate it, you'll get a figure of 2,08,000. Okay, I'll tell you for the share of profit also, you will subtract 2,40,000 from 5,70,000, and then you'll take its 30%. Which will come out to be 99,000. So when you'll add 99,000 to 1,09,000, you'll get 2,08,000 as your figure. Okay, this is the total NCI at the date of at reporting date, which is 31 December 20x8. See, here we have 2,08,000. So this is our correct answer, right? Now let's move on to the second question. Okay. Green Company purchased 8 lakh ordinary shares of Red Company on 1 October 20x6. Question number 2. So here in this question, Green has acquired Red. So Green is the parent company and Red is the subsidiary company. Now see, 8 lakh ordinary shares, or I can say 0.8 million of ordinary shares Green company has acquired. And what is the total share capital of Red company? See, 1 million, or I can say 10 lakh. So out of 10 lakh shares, Green company has purchased 8 lakh shares. So I can find out the percentage. Okay, I'll take the denominator. I'll take the total in the denominator, which is 10 lakh, or you can say 1 million, and I'll take numerator as my 8 lakh, which is the number of shares which they have acquired, and I'll multiply it by 100 to find out the percentage. So Green has acquired 80% of Red, right? Now next. And on that day, the retained earnings were 1,80,000 of Red company. The market value of each share of Red company, okay, which means subsidiary companies, $5.6. On 30 September 20x9, Red company has following equity. So they have 10 lakh shares and the value of each share is 0.5. So when we'll multiply both these figures, we'll get 5 lakh. And the retained earnings are 4,20,000, which gives us the total of 9,20,000, right? Now, what are they asking us to calculate? They have asked to calculate goodwill, consolidated statements, the goodwill which will arise in consolidated statements. We have to calculate that goodwill. So first, let's write the formula for goodwill. See, my formula is purchase consideration. Purchase consideration means anything. It could be shares, it could be cash, whatever amount which I have given to subsidiary to acquire that is my purchase consideration. Then to this purchase consideration, I will add fair value of NCI and I will deduct fair value of net assets of subsidiary at acquisition. Okay. Now let's try to understand this formula first. And we'll get our final goodwill figure. Now see, let us first try to understand what is the meaning of goodwill. Suppose today I purchased a business from you and your business had assets worth dollar say 80. Okay, your business had assets worth $80, but I paid you rupees 100 to acquire. Okay, I paid you rupees 100 so that I can get your business, but your assets just had $80. Then why did I pay this $20 extra? The difference is $20, right? Then why did I pay you this extra? I paid you this extra amount because of the goodwill, because of the name which you have made in the market. All right, so that is goodwill. Similarly here, now see, why do we add fair value of NCI here? Understand, when we are deducting the fair value of net assets of subsidiary, this is 100%. We are taking the complete, all the assets of the subsidiary, right? And here in this question, Green has acquired 80% of Red. So this purchase consideration is for 80% part. Can we compare something which is at 80 to something which is at 100? No, we have to make like by like comparison. So that's why to this 80%, I will add 20% of NCI. Then the total would be 100%. And from this, I'll subtract the fair value of net assets, which is also at 100%. If you didn't understand how this formula is made, it's okay. You can just learn the formula, right? Now let's put figures in our formula. Now see, purchase consideration. So 8 lakh shares were purchased and the market value of each share is 5.6. So multiply 8 lakh with 5.6. Okay. Then fair value of NCI. Now see, there were total 10 lakh shares, out of which 8 lakh are issued. It means 20% is left. You'll find out 1 lakh's 20%. Sorry, 10 lakhs 20%, which will come out to be 2 lakhs. And you will multiply it by the share price of subsidiary company, which is 5.6. All right. Now you will take the fair value of net assets of subsidiary at the date of acquisition. All right. Now these assets include, let me write. Wait. Now these net assets, they include share capital, and they also include the retained earnings, right? Now see, share capital we have 5 lakh. So here we'll write 5 lakh. Now retained earnings. Be very careful that these retained earnings of 4,20,000, this is at our reporting date. And we always calculate our goodwill at acquisition. That is when we acquired. We acquired it on 1 October 2006 when the retained earnings were 1,80,000. So here we'll take 1,80,000. Add them, we'll get 6,80,000. This is our net assets, fair value of net assets. There were no fair value adjustments, so we'll just add share capital and retained earnings. We'll get it as 6,80,000. So here, I'll put it in my formula. We'll subtract 6,80,000. So when you will multiply this and subtract 6,80,000 from this, you will get a figure of, let me calculate and tell you. It will come out to be 492,000. Okay, let's see if we have such option here. Yeah, see, the option. All right, now let's move on to question number 3. It says, Indigo Company purchased 80% of ordinary share capital of Purple Company. So Indigo Company is the parent company and Purple Company is the subsidiary company, right? Indigo had retained earnings of 6.5 million on 31 December 20x4. So the retained earnings of parent company is $6.5 million. Okay. Now, what are they asking? They are asking us to calculate consolidated retained earnings on 31 December 20x4, right? So, these are the retained earnings of parent on 20x4. We have to find the retained earnings of P, which is our subsidiary, so that we can find the consolidated retained earnings. The formula for consolidated retained earning is retained earnings of Indigo, that is our parent company, and the retained earnings, or I can say the profit of Purple Company, which is our subsidiary. So here, for the retained earnings of our parent company, it is directly given as 6.5 million, or I can write it as 6512345 zeros. All right. Now I have to calculate the retained earnings or the profits of my P company. So let's make a working note for this. Now see, Purple Company information we have been given here. We don't have to do anything with the share capital thing, all right, because we are calculating retained earnings. Now see, they have given us the retained earnings at 31 December 20x3 and retained earnings at 31 December 20x4. So let me draw a timeline here. This is our year end, which is 31 December 20x4, and our year start would be 1 January 20x4. Now see, the closing retained earnings at 31 December 20x3 will be our opening retained earnings at 1 January 20x4, right? So here I'll write 2600,000, all right? And the retained earnings at 31 December is 32 lakhs. Now I'll see the movement. The movement, that is 32 lakhs minus 26 lakhs will tell me the profits for the entire year. But see, Indigo Company has purchased the Purple Company on 1 May 20x4. Okay, so it has purchased it somewhere here on 1 May 20x4. So we will only take the post-acquisition profits. Okay, we cannot take the profits for the entire year. You just have to take profits for from 1 May till 31 December. So how many months these would be? May, June, July, August, September, October, November, December, right? So these would be 8 months. So I'll multiply this movement with 8. I hope you all have understood why we have taken 8, because these profits are for the entire year, and when we are consolidating the retained earnings, we'll only take those profits which are related to post acquisition, right? And now I'll multiply it by 80%, because Indigo owns only 80% of Purple Company. Okay, it does not own 100%. It owns 80%, so I'll multiply it by 80%. So now let's calculate it. When I'll subtract this Okay, just give me a minute, I'll calculate it. 32 lakhs minus 26 lakhs, it will come out to be 6 lakhs. Do 8 by 12 and then multiply it by 80%. So this would be 3,20,000. So we have calculated profits of our subsidiary company as well. Now let us put it in our formula. Here I'll write 3,20,000. Okay. Add both these figures. So my answer would be 68,20,000. All right. So I hope you have understood how did we arrive at this 68,20,000 figure. Retained earnings for the parent company was directly given, and we calculate the retained earnings of Purple company by looking at the movement and multiplying it by the share of Indigo company and then proportionating it by doing 8 by 12, right? Now let's move on to the next question. Question number 4. Purple company purchased 80% of 1,000,025 ordinary share capital of Yellow company. So here Purple company is our parent company and it has purchased Yellow company. Now this Yellow company had 1 million shares and each share had a value of 0.25. Okay, so number of shares of Yellow company are 1 million, or I can say 10 lakh, and value of one share is $0.25, right? So if I have to find the total share capital, I'll multiply both of these, right? So in order to find the share capital, I'll multiply the number of shares by the value of each share. So this will come out to be 2,50,000. Okay. Now let's read further. So they have purchased Purple company has purchased Yellow company for 4 lakhs. So the purchase consideration is $4 lakhs, right? The retained earnings of Yellow at acquisition was $2,10,000. The fair value of NCI is $1 lakh. They have asked us to calculate goodwill. So let us write the formula for goodwill first. So the formula for goodwill is purchase consideration. I've already told you the logic behind it, that we do a like-to-like comparison. So we'll add here fair value of NCI. And from here, we'll subtract fair value of net assets of subsidiary, right? So the purchase consideration, they have directly given that we have purchased it for $4 lakhs. So here I'll write 4 lakh. And they have also given us the fair value of NCI. See, here it is given $1 lakh. So here I'll write $1 lakh. Now we have to find the net assets of subsidiary. Now these net assets are made up of share capital and my retained earnings, right? When I'll add both of these figures, I'll get the net assets of subsidiary company. So retained earnings, they have directly given us as 2,10,000. See, we always calculate goodwill at the date of acquisition, okay? So look at the retained earnings at the date of acquisition. If you're not given the retained earnings at the date of acquisition, then you have to calculate. They must have given you some other information from which you can calculate the retained earnings at acquisition. So always take the retained earnings at acquisition date, because goodwill is always calculated at acquisition, right? So I'll write here 2,10,000. And I also calculated share capital above. Okay, that's why I calculated it. See, it is 2,50,000. Sorry. So this is 2,50,000. When I'll add them, I'll get a figure of 4,60,000. So I'll subtract it from here, 4,60,000. Now calculate the final figure. 4 lakh plus 1 lakh is 5 lakhs. And when we'll subtract 4,60,000 from 5 lakhs, we'll get a figure of 40,000. So this is our goodwill. Okay, this is our goodwill. This was the working note of fair value of net assets, and this is our goodwill of 40,000. Here it is given 40,000, right? Now next, let's move forward to question number 4. Or I guess it's question number 5, right? It's question number 5. Let's read it. Company purchased 60% of 5 lakh 0.5 ordinary share capital of Violet Company on a share for share exchange. So there was a company, they have not given us the name, but let's suppose it's X company. It has purchased Violet Company 60%. It has acquired 60% of the share capital. Now, this Violet Company has 5 lakh shares and each share is worth 0.5. So I can calculate the entire share capital, right? Multiply 5 lakh by 0.5. So this is 2,50,000. Okay. It exchanged 2 of its shares with a market value per share of 8.5 for 2 shares in Violet Company. So what has this company done? It has given Violet Company its 2 shares. It has given Violet Company 2 shares and it has acquired 4 shares of Violet Company. By giving 2 shares, it has acquired 4 shares, right? Now see how we will do this. First of all, look at the number of shares. This calculation was actually not required, but still, it's okay. Now see, the number of shares were 5 lakh and this X company has purchased 60% of it, so multiply it by 60%, right? Let me calculate 5 lakh 60%. It is 3 lakhs. Okay. Now, we will multiply this 3 lakhs by the number of shares which it has exchanged. It has exchanged 2 of its shares for 4 shares. So, we will multiply it by 2 and we'll divide it by 4. The number of shares which X company has taken of Violet Company will go in the denominator and the number of shares it has exchanged will go in the numerator. Now I'll multiply this figure by the market value of share of Violet Company, okay, which is 8.2. 8.2. So let me calculate it. Three lakhs multiplied by 2 divided by 4 and we'll take 8.2. So it will come out to be $12,30,000, which is our option number B, this. Okay, let me again tell you what has happened here. One X company has acquired Violet Company and how this acquisition has taken place. What is the purchase consideration? It is a share for share exchange, right? It means that X company has acquired some shares of Violet Company and in return it has also given some of its own shares. So it exchanged 2 shares with the market value per share of this for 4 shares in Violet Company. So it has taken 4 shares of Violet Company, which will go in denominator, and it has acquired 2 shares, so that will go in the numerator. And I'll multiply it by the share price of Violet Company. Okay. So the answer would be 12,30,000. Now let's move on to question number 6. Company purchase 60%. It's actually the repetition of the previous question. Okay. Both these questions were the same. It's okay. Let's move on to the next question. Burgundy Company owns 100% of Orange Company. So Burgundy's first company, which is the parent company, and Orange Company is our subsidiary. And it is a wholly owned subsidiary because Burgundy has acquired 100% of Orange Company. Okay. Orange Company sell its goods to Burgundy Company at a markup of 50% on cost. So the subsidiary company has sold certain goods to its parent company. Okay, so this is intra-group transaction, a transaction which is happening within the group. Okay, so imagine it like you are wearing a bottom with two pockets. Okay, so you are just transferring some money from the first pocket to some money in the second pocket. Okay, so imagine it like this. At the end of the year, Burgundy still has $600 of the inventory from its subsidiary of Orange Company. How much unrealized profit should be removed from inventory in consolidated statement of financial position? So now see, this Orange Company has sold certain goods to Burgundy Company. So obviously they will be selling it at some profit. Okay, Orange Company will sell it at a profit to Burgundy Company, right? So we have to remove this unrealized profit because both these parent and subsidiary are part of just one group. Okay, this is one group and Burgundy and Orange are a part of it. So we have to remove any unrealized profit. So this unrealized profit will be on the inventory which is still with Burgundy. Okay, so it has sold some goods and out of these goods only six goods worth $600 are in the inventory of Burgundy Company. So we have to remove unrealized profit relating to this $600, right? Now first let us find, just a second. So see, it sells Burgundy Company at a markup of 50% on cost. See, markup is always on cost. They have also given here on cost, but even if it's not written, then learn that markup is always on cost. So let us assume that the cost is X. Let the cost be X. Okay, so to this X, they have added a markup. Okay, 50%. So to this cost, they have added 50% of cost to arrive at the selling price. At the end of year, still has 600 of inventory. So they have the entire inventory. Okay, they sold 600. Orange Company sold goods worth 600 to Burgundy Company, and Burgundy Company has this entire inventory. Okay, they have not sold any part of this inventory. So when I added 50% of cost, when I took the cost of the inventory and added 50% to it, I arrived at the selling price, which is 600, right? Now I'll calculate it. It would be X plus 1 by 2 of X. I'll reduce it, right? Like this, which is equals to 600. Taking the LCM, which would be 2. It would be 2x plus x equals to 600. This is just simple maths, right? So 600 into 2 upon 3 I will get my x. So reduce it. My x would come out to be 400. So see, the cost price of the inventory was $400 and this Orange Company sold it for 600. This was my selling price. So what is the unrealized profit? It would be 600 minus 400. So it would be 200. Okay, since the entire goods are still in the inventory of Burgundy Company, so this would be my unrealized profit, $200. 200. So here I write 200. Okay, now let's move on to next question. I hope you all have understood the concept of markup. Markup is always on cost. That's why here I took X as the cost and added 50%. Okay, added 50% to it to arrive at the selling price. This is the easiest method. Now let's move on to question number 7. Oh, just a second. I don't know why it's behaving this way. Just give me a second. Yeah. Next question is Blue Company. Blue Company purchased 70% of $1 million one ordinary share capital of Lilac Company. Okay. Blue has purchased Lilac Company 70% for a combination of cash and shares. So purchase consideration consists of both cash as well as shares. Okay. It paid $5 lakh plus a share for share exchange. So the cash is $5 lakh, which is directly given to us. And we have to find the share for a share exchange, obviously. It exchanged one of its shares for 3 shares in Lilac Company. Blue Company shares were valued at $6.8 each, and Lilac Company shares were valued at $2.7 each. All right. So let's see. What is the fair value of consideration? So they are asking us to calculate this entire consideration, okay, whatever we have paid to acquire this Lilac company. So 5 lakh is directly given. So I just need to find the share for share exchange. So see how it will be done. The total share capital is 1 million, okay, or I can say 10 lakhs. I'll multiply it by 70% because Blue Company has acquired 70% of it. So this would come out to be 7 lakhs. So Blue Company has acquired 7 lakh shares of Lilac Company. Now I'll multiply this by 1 and divide it by 3 because it exchanged one of its shares for 3 shares in Lilac. How many shares it has acquired of Lilac Company? These are 3, so they will go in denominator, and my own shares which I have given is 1. So multiplied by 1. Now I will multiply it by, now tell me, Blue Company share were valued at 6.8 and that of Lilac was 2.7. So with which number should I multiply it? I will multiply it by 6.8, okay? I will multiply it by the share value of my parent company. So multiply it by 6.8. So let's see what comes out. Divided by 3. Multiply by 6.8. So it comes out to be 1,586,667. Okay, this is a round off figure. So right here, 1,586,667. Okay. Now I'll find out the total consideration. Add 5 lakh to this figure. So my answer would be 2,086,667, which is option number D. Right? So always remember to take the share price of Blue Company, that is our parent company. Okay. Now let's move forward to next question. White Company owns 80% share capital of Black Company. So White is the parent company and Black is our subsidiary company. Okay. During the year, Black sold $250,000 of inventory to White Company. So again, this is intragroup transaction. Black has sold some goods to White and they were worth $250,000. White Company, but at the year end, only $50,000 of these goods remained in inventory. So see, the total sales were worth $250,000, but at the year end, White Company has sold certain portion of these inventory and only inventory worth $50,000 is left. All right. Black Company makes a gross profit of 40% of sales. So this tells us that the goods were sold at a margin. Okay, margin of 40%. Whenever they say gross profit of 40% of sales, so they are talking about margin. Okay. So at the year end, White has an inventory balance of $120,000 and Black Company has a balance of $70,000. What amount should be shown in consolidated statements of financial position for inventory? So see, when we are taking the consolidated inventory, so in this case, I will take the entire inventory of my parent company's inventory, and I'll add to this subsidiary company's inventory, right? So I'll get the total inventory. But in this case, there is some intra-group transaction, okay, transaction between the same group, transaction from one pocket to another pocket, okay? So I have to remove this intra-group transaction. So see, my goods were sold on margin. First, I'll calculate my unrealized profit and I'll deduct this unrealized profit from my inventory. This unrealized profit would be deducted from inventory. So goods were $50,000 were left in the inventory. So take it's 40% because margin is always on the selling price. Okay, I've told you this 40% on sales is our margin, and margin is always on the selling price. So this 50,000 is our selling price. So directly take 40% of this 50,000. So this would be $20,000. Okay, now add the inventory of white company and black company and deduct 20,000 from this. Okay, so inventory of white company is 1,20,000. That of black company is 70,000, and deduct the unrealized profit of 20,000. So this would come out to be 1,70,000. So, okay, so this is option C. This, right? So see, we have covered both the things, the markup and the margin as well. Okay, so the markup is on cost and margin is on selling price. So directly I took 40% of 50,000, and I took 40% of 50,000 because my goods worth 50,000 were left in the inventory. Okay. Our next question. Polar Company owns 75% of Arctic Company. The following are extracts from their financial statement for the year ended 30 September 20x8. So let's first read the requirement. Which one of the following expressions shows us how profit attributable to owners is calculated? So fine, okay. C. This Polar Company is our parent company and Arctic Company is our subsidiary. And Polar has acquired 70% of Arctic. So whatever profit Arctic will make, the parent company has only 75% share in that profit. Alright. So we have to find the total profit. So 1,02,000, 10,20,000 we'll take as it is, that is of Polar Company. And in case of Arctic Company, we will take only 75% of it. Okay. So our expression would be the entire profit of parent company, Polar Company, 10,20,000, and plus in the brackets, we will take 75% of 4,35,000. Okay, so which is option number C. C, we cannot do A because Polar does not acquire completely Arctic Company. Okay, so this they have done 100%. So this can't be the option. The second option they have done is 10,20,000 plus 4,35,000, and they have taken 75% of it. It can't happen. The parent company will include its entire profit. Okay, so when they are doing 75%, when they are putting brackets here and writing 75% outside the bracket, it means they are taking 75% of 10,20,000. But we can't do this because Polar Company will take its entire share of profit. Okay, then C was the correct answer, right? And in option number D, what they have done, they have taken profit before tax. No, we always have to deduct tax expense, then only we can move to the profit figure. All right, now let's move forward to the next question. Just a second. Lion Company bought 80% of Cup Company on 1 April 20x6. Okay, so Lion is the parent company and Cup is the subsidiary company. And it is done on 1st April 20x6. Both companies prepare financial statements for the year ended 31 December. So this is a mid-year acquisition, okay? Our year is like this, 31 December is the year end. So the year start would be 1 January, go 12 months behind. And this acquisition took place on 1 April. That is after 3 months, January, February, March. After 3 months, acquisition was taken place. So post-acquisition months are 9 months. Okay. So we have been given the sales, cost of sales, and gross profit. Okay. Following the purchase of Cub Company, Lion Company sold to Cub Company for $1,50,000 at a markup of 50%. At the year end, Cub Company had none of these sales in closing inventory. So this line is very, very important since the entire goods were sold. Lion Company sold some goods to Cub Company, but at the year end, when the financial statements are prepared, Cub Company has already sold the entire inventory. So it means that there is no unrealized profit, okay? Because Cub Company does not hold any inventory now, okay? So we do not have to do any unrealized profit adjustment here, okay? We do not have to do any calculations in this respect. They are asking us to calculate what amount should be shown in consolidated statement of profit and loss for sales and gross profit. Okay, this is very easy. Just remember that we will not do any adjustment for unrealized profit because entire inventory has been sold before the year end. So what will you do? You will take the entire sales of Lion Company, and for Cub Company, you will multiply it by 9 by 12 because this is a mid-year acquisition. Okay. So post-acquisition months are 9. So multiply it by 9 and divide it by 12. And what else they have asked us to calculate? Gross profit. So similarly, we will take entire gross profit of Lion Company, and for Cub Company, we will multiply it by 9 by 12. Right? So let me do it here. This is my Lion Company. This is my Cub Company. Sales 43 lakh 50,000, and for Cub Company it is 21 lakh 500 multiplied by 9 by 12. So this will come out to be, let me calculate it. $21 lakh multiplied by 9 by 12. So this will come out to be 1575375. But now remember one thing. These were the sales of Lion Company and these were the sales of Cub Company. But see, Lion has sold some goods to Cub. So this is intra-group transaction. Sales have been made in the same group. So we have to remove this intra-group transaction. Okay. So you'll add 43 lakh 50,000. You'll add 1575375, which is the sale figure of Cub Company. And to this, from this, we will subtract 1,50,000 because this is intra-group sales. So you have to remove intra-group sales. We will not make any adjustment for unrealized profit, but we have to make adjustment for the sale because this has taken place between the same group. Okay. So when you will do this calculation, let me just quickly calculate it. 3 lakh 50,000 and deduct 1 lakh 50,000 from this. So I'll get a figure of 5775375. Okay. So this was my sales figure. See here, there's option 2. And gross profit, this is very simple. Take the entire gross profit of Lion Company and take 9 by 12 of this Cub Company. So the total would come out to be 229665. Okay, so our answer is option D. Right? Now let's move forward. East Company owns 80% of West Company. Just a second. Yeah. So East is our parent company. West is the subsidiary company. It owns 80%. During 20x3, West paid a dividend of $1,20,000. Okay. So they have given us gross profit. They have given us the investment income of both the companies. What amount should be shown in consolidated statement of profit and loss for other income? So this investment income is our other income. So we have to calculate the total consolidated other income. So we will just simply add 1,70,000, which is East Company's investment income, and we will add 65,000, which is West Company's investment income. But see, West Company has paid some dividend to East Company as well because the West Company in total has paid 1,20,000 of the dividend, right? But it has paid it to the East Company as well. But now see, this East and West are a part of the same group. Okay, this is just like transferring money from one pocket to another pocket. Okay, so we have to remove this effect. So what we will do, we will deduct 1,20,000 But we will not deduct this entire 1,20,000. We will just take 80% of it, because the rest 20% relates to NCI. Obviously, subsidiary will pay 20% of its in dividends to NCI, but the 80% which relates to the parent company, we will deduct that because it is the transaction in the same group. We are transferring just from one pocket to another. So it doesn't make any sense. So we have to remove it. Okay. So let's calculate it. 1,20,000, 80%, it will be 96,000. So 1,70,000 plus 65,000 minus 96,000. Let me do it. So it will come out to be 1,39,000. Okay. 1,39,000, which is option C, right? It was a very easy question. Just be careful that we have to remove intra-group transactions, and we will only remove the extent to which parent company owns subsidiary company. Parent company owns 80%, so we will remove the effect for only 80%, right? Now next question. Maxi company owns 60% of mini company. For the year ended 30 June 20x4, the following profits were earned. So 1,13,25,000 and 8,50,000. During the year, Mini sold $1,20,000 of goods to Maxi company with a markup of 50%. Okay, so markup is on the cost. So let me write here. Next question. Maxi acquires 60% of Mini, and who has sold goods to whom? Mini has sold goods to Maxi for $1,20,000. Okay. At the year end, half of these goods were still in the inventory. Okay. What should be shown in consolidated statement of profit and loss and other comprehensive income for total comprehensive income attributable to NCI? Alright. So now see, when Mini company has sold certain goods to Maxi company at a profit, so this profit must be lined in the profits of Mini company, okay, because they have sold goods to Maxi company at a profit. So this profit is lined here, okay. But when we are doing consolidation, we have to remove this unrealized profit, okay. So we will subtract unrealized profit from this 8,50,000 figure. So now see how we will do it. Let us first calculate our unrealized profit. So see, let the cost be X. Let the cost be X. So X plus 50% of X will give us $1,20,000 because this is the selling price. Okay. So just quickly calculate it. Here we will get multiplied by 2 divided by 3. You can calculate it. This is just simple maths. This will be 80,000. Okay. So the selling price was 1,20,000 and the X was our cost, which is 80,000. X is our cost price. So profit was, subtract these both, 40,000. Now see, we have sold 50% of the goods. At the year end, half of these goods were still in inventory. 50% were sold, 50% was left. Okay. So we will calculate unrealized profit for the remaining portion, which is 50%. So our URP is 20,000. All right. Now we have to calculate the total comprehensive income attributable to NCI. Okay, just a second. We have to calculate it for NCI. So take Mini company's profit 8,50,000. Okay, multiplied by the NCI portion. Maximum 60%. So remaining 40%. 100 minus 60 is 40%. That relates to Mini company's NCI 40%. Okay, take that portion and subtract the URP 20,000. So 8,50,000. 40% and deduct 20,000 from this. So our answer would be, just a second, there's something wrong here. Let me figure it out. So guys, see here, we have to calculate NCI's share, right? So see, the total profits of mini company is 8,50,000. So NCI will have a share of 40%. And the URP, which we will deduct here, would be, which relates to NCI. So our total unrealized profit was 20,000. Okay, we will take 40% of this figure because NCI's share is 40%. So let's calculate it now. 8,50,000, 40% is 3,40,000. And the unrealized profit, which relates to NCI's share of unrealized profit is 40% of 20,000, which is 8,000. So subtract these both, you will get 3,32,000. All right. So be very careful about what they are asking. Initially, I thought that they were asking about the consolidated profits. Okay. But no, they were actually asking about the NCI's share. Okay. So we took 8,50,000, 40%, and we deducted just the portion of URP which relates to our NCI. Okay. Now let's move forward to the next question, which is our spring company question. So spring purchased 90% of autumn. Just a second. Okay. What amount will be shown as profit attributable to owners? Okay. Just a second. Yeah. So this acquisition took place on 1 October. On 1st October it took place, and our year end is 31 December. See, 31 December is our year end. So year start must be 1 January. So what are the post acquisition months? October, November, December, just the 3 months. Okay. So when we are taking profit attributable to owners, we will take spring company's entire profit, which is 1,792,000. Yeah. And autumn company's 5,405,000. We will only take 3 months profits, and we will multiply it by 90% because spring company owns 90% of autumn company. Okay. So this was very easy question. You can just simply calculate it. Only calculation part is left, nothing else. I'll tell you what will be the final answer. It would be 1,913,6,125. All right. So they had given us the group statement of profit and loss, wherein they added these both the figures. Okay. But we will just take 90% of this, that too only for 3 months. Okay. Next question. Honey Company acquired 75% of B company on 1st April 20x6, paying $2 for each equity share. So Honey has acquired B 75% on 1st April 20x6, and they have paid $2 for each equity share they have acquired. All right. The fair value of NCI they have given, and they have given us the equity share capital of B company and the retained earning of B company at 30 September, which is our reporting date. Okay, fine. What is the goodwill on acquisition on when April 20x6? Right. So see, goodwill is purchase consideration, which is our share for share exchange, right? No, that's not share for share exchange, but see, the share capital is $1 each, and which comes out to be 1,000. So since each share is of $1, so it means that total shares of B company are 1,000. Honey has acquired 75% of these 1,000, so multiplied by 75%, and they have paid $2 for each equity share they have acquired. So they have acquired 75% of 1,000, and I will multiply it by 2. So I will get my purchase consideration, right? Now, in the goodwill formula, what do we add next? We add the fair value of NCI. So this is $300. Right, okay. Let's calculate the purchase consideration as well first. Then we will move on to our net assets part. So 1000, 75% multiplied by 2. So it comes out to be 1500. Fine. Now let us subtract the net assets of subsidiary at acquisition. Net assets of subsidiary at acquisition. So I told you that it consists of share capital as well as the retained earnings. Okay. So share capital, it's given 1000. We have to look at the retained earnings. So see, let us make a timeline. Okay, it's okay. Let it be like this. So our year end is 30 September 20x6. Just a second. Yeah, 20x6. So year start would be October 1, October 20x5. And acquisition took place on 1st April 20x6. So it means October, November, December, January, February, March, after 6 months. So pre-acquisition months are 6 months and post-acquisition months are also 6 months. Right. So the profit for the entire year was 2,50,000 and the retained earnings at this date were 7,710, okay, 710. So now I have to see the retained earnings at this date, okay. We always calculate goodwill at the date of acquisition and my date of acquisition is 1st April. So what will I do? I will take the profit figure for these months. I'll take the profit figure for these months and I'll subtract it from 7,10,000. So I will arrive at the figure which are the retained earnings on 1st April. Okay. So my profit were 250. I'll multiply it by 6 by 12. I'll take half of this, which will be 125. All right. So I will subtract this 125 from 710. So 710 minus 125, which is 585. So my retained earnings at acquisition are 585. 710 minus 125. See, I'll repeat what I have done. They had given me the closing retained earnings, which was 710. All right. And they had given me the profit for entire year. So at the acquisition, I have to see what were my profits at the time of acquisition. Okay. So what did I do? I subtracted my post-acquisition part from my closing retained earnings, right? And then I arrived at the profit at the retained earnings, which were on the date of acquisition. These were 585. So when I'll add both these, I will get a figure of 1585. So this was the only thing which I had to put in my formula. So 1585. I'll subtract from here. So my answer would be plus 300 minus 1585, which is 215. So this is option D, right? Now let's move forward. Pulbro Company acquired 75% share capital of Solheim Company on 1 May 20x7. So P is parent and S is subsidiary. They have acquired 75% on 1 May. The terms of Pulbro Company's offer were $0.5 shares in Pulbro Company for $4.1 shares in Solheim Company plus a cash payment of $0.35 for each Solheim Company share. The market price of Pulbro Company on 1 May 20x7 was $1.6. At 1 May 20x7, Solheim Company had 5 lakh issued shares. So guys, this question is very much similar to what we have previously done. Okay, they had asked us to calculate the fair value of investment. It means we have to calculate the total investment which we have done. So you just have to take the cash figure. Okay, they have made payment in cash as well as a share exchange. All right, so you can easily calculate it. Okay, we have already done such a question, so practice it on your own, right? So, okay, fine. Now let's move forward. Peterfield's company acquired 65% share capital of Stockbridge Company on 1 July 20x1. Peterfield Company makes a financial statement on 31 December. Okay, again, this is a mid-year acquisition. Stockbridge Company earned a profit of 1,80,000 during 20x1 evenly throughout the year, right? Which formula will be used to calculate NCI in Stockbridge Company for Peterfield's group, right? So they have asked us to calculate the NCI figure. So what is the formula for calculating NCI? At the reporting date, it is the fair value of NCI plus share of post acquisition profits. Okay, so Petersfield has acquired 65%, so it means we will take 35% of this. Okay, right. Just a second. So the profit for the entire year 1,80,000. So they have not asked for any calculation. We just have to tell how we will express it. So right, it would be fair value of NCI on acquisition. It can't be this option because they have taken 35%. So eliminate it. Fair value of NCI retained earnings. No, we do not take this. It would be fair value of NCI on acquisition plus 50% because this was a mid-year acquisition and they acquired 35% of the profits. Okay, so this is our correct option. In A option, they have not taken 50%. Remember to take 50% because it is a mid-year acquisition. The acquisition took place on 1 July. So we will take profits from 1 July till 31 December. So for 6 months, right? This was also an easy question. You will get such questions in your exam. The entire exam won't be filled up with tricky questions. There would be certain questions which will help you pass the exam. Okay. Now let's see next question. They have asked us to calculate the cost of investment. So first, see, they have asked us to calculate cost of investment in South Sea Company. South Sea is the subsidiary. So first of all, let's look at the formula of cost of investment. The cost of investment means the fair value of net assets acquired plus the goodwill. Okay, it is fair value of net assets plus the goodwill. So see, Port Sea acquired 100% share capital of South Sea Company on 1 September 20x9. On 31 December 20x8, South Sea Company's share capital consisted of 1,000,025 shares and South Sea Company did not issue any shares during 20x9. South Sea Company's retained earnings at 31 December 20x8 were 5,10,000 and it made profits of $90,000 in 20x9. Goodwill on acquisition was $70,000. Okay, so much of information. It's okay. Let's start by putting in our formula. Goodwill figure is directly given 70,000. Okay, so I can write 70,000. Now I have to work on this fair value of net assets. So I have already told you that this fair value of net assets is made up of share capital and our retained earnings at the date of acquisition, right? So see, the share capital is 1 million and each share is worth 0.25. So multiply 1 million with 0.25. Guys, please don't do the percentage. Like suppose Port Sea acquired 80% of it. Do not calculate 80% of it because here we are looking at the entire net assets of subsidiary. Okay, so please do not multiply it by any percentage. We always take 100% of it. And for retained earnings, now see, let us read it again. So the year end is 31 December. Okay, this is our timeline. Year end is 31 December 20x8. So year start would be 1 January 20x8. And acquisition took place on 1st September. Means September, October, November, December. Post acquisition months are 4. Okay. So on 31, see, at 31 December 20x8, retained earnings were 5,10,000. So here, retained earnings were 5,10,000 and the profits for the entire year were 90,000. For this entire year, profits were 90,000. So if I have to reach at the retained earnings on 1st September, what will I do? I will subtract 90,000 4 by 12 from this 5,10,000. Okay, I'll do backward working. This 5,10,000 includes the profit for the entire year. Okay, so I'll just a second. Just give me a second. First, let's calculate 4 by 12 of 90,000. It will come out to be 30,000, right? So, okay, so see how you'll do this. Do not take 4 by 12 of this. We have to calculate retained earnings at this date. Okay, so this is made up of. So actually, I'm really sorry. I read it incorrectly. This 5,10,000 is our opening figure. Okay, our current year end is 20x9, not 20x8. It is 20x9, which is the current year. Okay, 20x9 is our current year, and they have given us the retained earnings at 31 December 20x8. It means these are the opening retained earnings. The closing retained earnings at 31 December 20x8 would be our opening retained earning on 1 January 20x9. So this is 5,10,000. Right? So I have to calculate retained earnings at this date, which is, so to this 5,10,000, I will add profits for these months. So it would be profits for 8 months. Right? Do you understand it? We were given the opening retained earnings. We were not given the closing retained earnings. If we were given the closing retained earnings, then we would have subtracted 4 months profit. But we have been given the opening retained earnings, which are 5,10,000. So this I will add 8 months profit to reach at the retained earning figure on 1st September 20x9. So take 90,000 8 by 12. So this will come out to be, I'll calculate it. Wait a minute. You can do calculations simultaneously. 60,000. Add it here. 5,10,000 plus 60,000. So it would come out to be 5,70,000. Right? We have calculated the retained earnings, 5,70,000. You will calculate the share capital. I'll do it for you. 1 million multiplied by 0.25, just 2,50,000. So add these both, 2,50,000 plus 5,70,000. It is 8,20,000. Put it in your formula. Here was the formula. Cost of investments formula was fair value of net assets. We just calculated it as 8,20,000. Goodwill was directly given, 70,000. Add them both, you'll get 8,90,000, right? Next. So we are only left with 2 more questions. If I'm not wrong, let me check. Yeah, just 2 more questions, then we'll be done. So see, Patting Company acquired 80% shares of Samudan Company at 1 January 20x7 for cash of 24 lakhs. Right. Samudan's share capital on 1 January 20x7 was $2 million, $1 shares. Okay. So number of shares were 2 million and each share was worth $1. So share capital is 2 million multiplied by 1, it should be $2 million only, right? The carrying amount of equity share capital and retained earnings of Samudan Company, that is our subsidiary company, is 26 lakhs. Okay, so they have given us both the share capital plus the retained earnings figure. These both are $26 lakhs. All right. Now see, Samanthan Company's non-current assets were included in the account records on 1 January 2007 at 5 million. But a valuation of land and building showed that the fair value of non-current assets were 52 lakhs 50,000. Okay. Pattingan Company's values NCI at fair value. The fair value of equity share is $1.5. So what do we have to find? We have to find the goodwill. So see, give me just a second. So in case of calculating goodwill, we always take the purchase consideration. To this we add fair value of NCI and we deduct the net assets less net assets. So here we have a new calculation for net assets. You will see how to adjust fair value of net assets. Okay, this purchase consideration and fair value of NCI part is just like the normal questions which we did before. So you will do this calculation yourself. I'll just explain you the net assets part. See, whenever we acquire a subsidiary, we have to take the fair value of the net assets of subsidiary on that day. Okay, so the fair value is calculated according to IFRS 13. Okay, that is right now not in your syllabus, but just understand this, that we have to calculate the fair value. So the net assets are made up of share capital and retained earnings. Okay, they had given us share capital and retained earnings. So this was given as 26 lakhs. Okay, earlier they had given us some adjustments in retained earning, but in this question they have directly given us the retained earning and share capital at acquisition. What else I have to do here is I have to adjust the fair value. So see, when this acquisition took place, the land and building were worth 5 million, but the fair value of this land and building on acquisition was in the books they showed at 5 million, but the actual value on acquisition was 52 lakh 50,000. So see, the value has increased from 5 million, or I can say 50 lakh, it has increased to 52 lakh 50,000. So what is the increase? The increase is 52 lakh 50,000 minus 50 lakhs. So this increases of 2 lakh 50,000, right? So add this 2 lakh 50,000 in your fair value of net assets, because we take fair value of net assets on acquisition. So when you will add it, you will get a figure of 28 lakh 50,000. Okay. So here you will subtract 28 lakh 50,000. So only new part in this question was the calculation of net assets of subsidiary, wherein we looked at how to calculate the fair value. All right. You can calculate the purchase consideration and that NCI part. Now, next question, they have asked us to how will we show consolidated figure for trade receivables and trade payables. All right. Easy. Pink acquired 80% of Scarlett. Pink is the parent company. Scarlett is the subsidiary company. They have acquired 80%. On 1st January, this acquisition took place, and on 31 December 20x2, they have told us the trade receivables of Pink and Scarlett and the current trade receivables of both the company and trade payables of both the company. Okay, as a result of trading during the year, Pink company receivable balance included an amount due from Scarlett 4,600. Okay, so now see, normally how we will calculate the consolidated trade receivables? We will just take P company's trade receivables. We will take S company's trade receivables. So 50,000, we will add 30,000. We will reach at a figure of total consolidated retained earnings. But here, what has happened? Pink company has to receive 4,600 from Scarlett company. Okay, Pink company must have sold some goods to Scarlett company. So now it has to receive 4,600 from Scarlett company. So this is a receivable for Pink company because it has to receive some amount from Scarlett company. Okay, at the same time, this 4,600 is a payable for Scarlett company because it has to pay something to Pink company. So this 4,600 must be included here in the 50,000 because Pink company has to receive. So it is a receivable for Pink company, and at the same time, Scarlett company has to pay 4,600 to Pink company. So this must be lined here in 42,000. So what we will do, we will add 50,000 and 30,000 and we will remove 4,600 because this 4,600 is an intra-group transaction. This transaction is happening in the same group. So we eliminate all the intra-group transactions. So we will subtract 4,600 from here. Similarly, for trade payables, we will take entire trade payables of P company and we will add 42,000, which are the trade payables of Scarlet company. But we will subtract 4,600 from here because it is an intra-group transaction. Okay. So you can calculate it and you will get the correct answer. So I'll calculate it. So 50,000 plus 30,000 minus 4,600, which is 75,400. So trade receivable figure is 7,500 and trade payables figure is 70,000 plus 42,000 minus 4,600, which is 1,07,400. So this is option D, right? So yeah, that's it. So we did 20 good questions. These questions covered a wide variety of topics. So you can revise them before your exam or if you're just normally practicing this chapter. So this video is perfect for you. If you think you have any doubt, you can ask in the comment section or you can just revise it. Yeah, so that's it for this video. Thanks for watching.